Hey guys, it's Tuesday, December 16th, 2014, and doing a long overdue vlog entry. I can't believe it's almost 2015. It's crazy. I also can't believe I have 47 subscribers to my YouTube channel, which it still blows my mind. Thanks to all you guys. Didn't really, when I started this, I didn't expect to to have anyone following me, but um, it's really cool to see. But today I'm going to talk about trade management, something I got asked about. And, I'll be the first to admit that every day I trade, I always find something wrong with my trading. And I make mistakes all the time. And it really is a matter of identifying the mistakes that you're making repeatedly, quickly, and fixing them before they really cause some damage. But there are some basic guidelines that I follow, and some philosophies that are behind my trading, and that's what I'd like to discuss here. So um, I have a chart here. This is from December 8th, and this in particular, this day, I think I posted about it. I was frustrated about this second trade here because uh, I you can see where my my entry, I got in down here. My stops for pretty much at break even, and my target was up here. And had this huge thrusting candle that came in. And if you just compare this candle to any other of the candles on this chart, this candle's range is like 3 times that of like any other. I'm not talking about these little candles, but like take the largest candles, the largest range of these candles. You can see that this just completely outweighs everything else. And my swing trading, when I see candles like this and it's so close to my target, I will generally just cut the trade and take profit. It's something I didn't do, and it was partly because the way it pulled back so fast. So by the time I was thinking about, I should probably cut this trade here, it just didn't have a chance to really put that into action. And closing the trade manually is just something that's not in my system for scalping. And with scalping, this stuff has just got to be automatic. You just got to be on the ball, and I wasn't. Um, but I wanted to bring this example up because it illustrates something, just a general principle that I put into practice when I manage trades. And I'll try to start. I didn't really structure this, but I'm gonna try to just ramble on here and see where this takes me. But the first concept that a trade management is something that uh, there was a point. I was reading my journal actually from years ago, and I remember when I had first started to identify a setup and finding success at just getting in the market at the right time and being quote unquote right on the trade, and then finding that I would get in these trades and they just run, but I'd never had a clue as to where to get out. And more often than not, these trades, and I was trading demo at the time, but I mean, it was still frustrating. These trades would come all the way back at me, and I remember I had an entry in my journal. I was reading it, and it basically paraphrased. It was like, I'm never gonna get this. This is just driving me insane. There's just no way I can do this. And it just really missing the components to a profitable strategy. And you hear the time and time again people saying like, um, it's getting out of the market is as important as getting into the market and blah blah blah. And I'm like, yeah, but how do you actually do that? I mean, what's the secret? What's the um, some basic concepts and I hope everyone knows this. I'm just going to cover it just because it's just to formally cover it. But a profitable strategy is made up of 3 components. I say 3. It's really 2. Um, and I'll explain the third one because it does have an impact, but it's not. It's not in the same way. Um, you'll hear everyone say that in order to be successful at trading, you need to win more times than you lose, which we know is rubbish because you can have perfectly profitable strategies where you lose way more than you win as long as your winners far exceed your losers. The other thing that you'll often hear is that for every trade you take, you got to have at least a 2-to-1 risk reward ratio, and that's completely one-sided. Both of those statements are missing. They're missing each other. They're missing. It's those two components need to be put together. Because saying that you need to have, for every trade you take, you need to have at least a 1-to-1 risk reward or 2-to-1 risk reward, otherwise you have to pass on the trade. That model is completely useless out of the context of your own trade statistics. So depending on your strike rate, you can determine whether or not a 2-to-1 risk reward is actually necessary, because it's possible that with, let's say for example, if you had something outrageous, was like I don't know, like a 95% strike rate, which I don't think anyone has. I'm sure some people do, but that's if you have a 95% strike rate, uh, you can take much less risk reward than 2-to-1 all the time, because um, and there's a you can look up the expectancy formula to actually calculate exactly what it is. But and I'm going to do that with this trade just to show an example here. Um, this particular trade, let me take a step back before I get ahead of myself. I said that there are three components. All right, so those components are: one is your strike rate. So that's the percentage of times that you win versus the percentage of times that you lose. All right. The other component is how much you're winning versus how much you're losing on average. And those two components make up will determine whether you have a winning strategy or a losing strategy. And the third component that I mentioned is a factor to consider, although it's, if you have those first two components, I mean, you either have an edge or you don't. But the third component is how many trade opportunities you get in a period of time. So, for example, if someone, someone has a if someone has a 95% strike rate, but they're only getting like one trade a year, um, the person with a much lower strike rate is probably going to make out ahead because they get more trade opportunities to execute their edge. So you can have a high strike rate, but if you only get like one trade a year, you're not getting enough trades to execute, or profit from the edge that you have. So aside from the fact that I don't know how you'd even calculate it. There's such if you take one trade a year, you're not going to have a sample size large enough to determine whether you have a profitable strategy to begin with, but that's a whole nother story. But the other concept is that risk reward is not static when you're in the trade, and that's very important, because you'll hear a lot of times that you just sort of calculate your risk reward to begin with. You figure out where you're going to put your stop, you figure out where you're going to put your target, and just enter the trade and let it play out, and bingo, you have when it moves in your favor, just move to break even, and you have a free trade. Well, um, there's a number of problems with that. Risk reward is not static; it changes throughout the course of the trade. And I'm going to illustrate with this particular trade that I was in. When I entered this trade, my stop was down here, and I'm going to get a little bit into stop placement as well. But at the time that I entered my trade, now I'm trailing, so I have a split target. So my my risk reward is somewhere around. I should be able to calculate this on the fly, but I can't. But it's like I'm like terrible at math. Somewhere around 2-to-1, and so it's probably it's like just put the target somewhere in here, this area. But basically, when I'm entering this trade, I have something of a 2-to-1 risk ratio. All right, and so in other words, I'm risking this much, risking 8 points to get this much. And since it's split targets, I'll just probably put this in the middle here. So that's my risk reward. So that's my risk, that's my reward. You can see it's easily about 2-to-1. All right, now that's all fine, but as the trade progresses, let's see, the first target's taken out, and now the market's pushing up greatly. Let's just take it to right to this point here. Okay, now what's my risk and reward on this trade? All right, well, I no longer have a 2-to-1. In reality, I'm risking, what is this? Oh, yeah, 22. Risking 22, well, 20, actually, since that's where my stop is, but risking 20 points to make 5. Okay. Now, I really have no logical place to, at this point, to bring up my stop because there's just no developing structure that's happened at this point. So I don't know where my stop should go at this point. And the correct thing, at least for me, in the way that I trade, the correct thing to do at this point, like I said, was to actually close out the trade at this point because it was so close to target. My risk reward has degraded to the point where it's no longer worth risking this amount just to make these 5 extra points. All right, and you often hear people say like, just let your winners run, and you got a free trade. Those same people, just ask them, let's say that you were out of this trade to begin with, and the market is now, just pretend that these order entry lines aren't even there. All right, and just pretend that the market's here. Would you enter this market here with a target here? With your stop all the way down here? I hope you're saying that you'd be out of your mind to do that. But that's essentially what you're doing if you're in the trade. People, if they're in the trade, the dynamic suddenly changes and they're like, oh, just let your winners run. But when they're out of the trade and they're thinking about getting in at this point, they'd say you're nuts. You're absolutely insane to buy here, trying to make 5 points and risking 20. So, but let's do this in a mathematical way. So let's actually do the expectancy formula for this. So I'm looking to get 5 points, and my strike rate is currently 63%. Okay. While I'm risking 20 points, and the opposite of that is 37%. All right, so I can't take that trade. All right, because if I keep on taking trades like that, for each trade like this I take, I'm losing 4.25 points over time. In other words, you're bleeding money. So, so that's the mathematical explanation for for why I can't take that trade. But that's what if you ever have a question about whether should I take a 2-to-1 risk reward, should I stick with 1-to-1, like if you ever have those questions, the answer is what is your strike rate? You just need to know your strike rate in order to figure out, can I take this trade or not? And if your strike rate says you can, if you can get away with it, if you have an extremely high strike rate, then yeah, you probably could take what is that? It's a 0.25 risk reward. By all means, but the answer to that question, of whether you should use 2-to-1 or whatever risk reward, it comes from your strike rate. And just to clarify the expectancy formula, what you're doing is you're taking your average win times your the average times that you win, the percentage of winners, and you multiply those two, and then you subtract your average loss times the number of times on average that you lose. That's 37% in this case. All right. So, and there's your answer. Let's just to fill in some numbers. Let's say you did have a 95% strike rate. Okay. If you have a 95% strike rate, for each trade like this you're taking, you're making on average almost 4 points. All right. So if you have a 95% strike rate, yeah, you can take that. You can take that trade. So, but it's again, it's one of those things that are often become blanket statements, and you gotta use the context of your own trade statistics to answer that question. So I hope that's clear. And for those of you that weren't fully aware of that, I hope picked something up from there. This trade, gosh, it was frustrating because I'm actually scoping out a place like where the heck can I put my stop here, and but just by the time it pulled back, it was too late, and there's just nothing I could do, and so and the thing I'm not going to do, I'm not going to just let it come all the way back down, which is just kind of sucks because I was almost certain it was going to get taken. I was just maybe a little I didn't give that too much. Now the interesting thing is that I actually managed to get in on a third trade on this day, almost at the same point I got out. So I got out at 13, I re-entered at 15. So in this sense, it was basically like I was just picking up where I left off. But the key here is that this is a setup. This is actually a setup. We had this break and then a retest of this level here, and so you see that strong rejection. On a totally unrelated note, in scalping, if this sort of thing had happened on the hourly chart, and if this were a position type of trade, this is an excellent pyramiding opportunity. For those of you that wonder, how pyramiding actually works and like how to properly do it. Pyramiding is when you build a position in the market. In other words, you enter at a certain price, and then as the market moves in your favor, you actually hold on to the trade and you keep on adding on the way up. And there's definitely a right and a wrong way to do it. The wrong way to do it is to just jump in the chart anywhere just because you feel like, oh, this market's looking really strong, and you just sort of like just hop in anywhere in the market. That's not the way to do it. There are certain criteria. I think I might just talk about this a little bit. If this were a position trade and I were looking to pyramid, there's really two rules to follow with this, and one is that for each re-entry or each second or third or each subsequent entry that you make to build to your position must occur as an actual setup, so in other words, if you weren't in the market to begin with, the point where you enter actually has to be a setup that you would take if you weren't in the market at all. So this qualifies because once it re-entered, that actually is a setup for me. So if I were in this position still down here, this would qualify as a point to enter. The other criteria is that, and this word scalping is problematic because there's no way I can calculate this, in the split second that it happened. But let's just pretend this was an hourly chart, and I had all the time in the world to pull out a calculator and figure this out. The setup needs to set up in such a way that when I position size the extra, the extra contracts, that my total risk never exceeds what I was risking to begin with. All right. So in other words, if I was risking, let's just say monetary value, if I was risking $160 in this original trade, however I add to the position, my stop, obviously my stop would have moved up from the original position, but my stop can never be in a point where if the trade were to just completely go go pear-shaped, um, my total risk can never exceed what I was originally risking in the first place on the onset of the first trade. And so that's really the two criteria. It's something I've never had an opportunity to do in scalping, but when I was looking at this, I was thinking, man, this is one of those just really great examples of times when you could pyramid a position, and but that's a whole nother topic. Um, Let me talk about stops a little bit. There are just general guidelines that I follow for stop placement, and however you trade, the the general rule is that your stop should go in an area where if it gets to the stop, you're no longer feeling right on the trade premise that you entered on to begin with. All right, so for instance, with this trade here, I was my first trade was here and my stop was down here. Now I could have moved my stop a point below, and it probably would have been fine because a point is okay. All right, if I'm feeling really confident in the trade, again, going back to my strike rate, okay, I can risk an extra point because my strike rate says that it's okay. I'd still be okay probably with that trade if my trade premise was correct, and if I keep on taking trades like that. But the general feeling is that my stop is where it is, and uh, if the market is just going to completely barrel down towards it, at least, I mean, the times when it actually hits the stop and then just completely goes in your favor actually don't happen that often, at least in my experience. And but I think it's one of those things that it has a tendency to stick in your mind. Um, and the same is true in life in general. I mean, you have a tendency to remember the moments in your life where you came close to something, and you sort of forget the other 1,000 times where you just completely failed on, there's definitely a psychological aspect to it, but I think a lot of people get caught up in, with that sort of that fear that in the market that it's going to touch your stop, tag your stop, and then just take off in the other direction. And honestly, I've had that happen very few times. It actually happened this morning. I made a little comment about that, um, that plays into just emotions, and um, the bottom line is that your stop needs to just be in an area where your trade premise is just invalidated. And there's some nuances with scalping. Like, so for instance, if this were a position trade I was taking or a swing trade, there's no way I'd have my stop there. There's just no way, because my stop is right on a level, and this wouldn't be a swing trade to begin with. Actually, just it wouldn't fit my criteria. This was just, this is scalping. It's in the moment. I had a strong case for this trade to go to the upside. If I were looking on this hourly chart, I wouldn't have the benefit of seeing how this trade played out to get that sense. But what I'm expecting is for this market to just take off at this point. I'm expecting to this area not even be hit. And you have to kind of have that trade expectation of not just where the market's going to go, but also how it's going to play out. And that's just something that comes from, just screen time. But you have to use that info to really get a sense of when the trade isn't going well, and when it's likely that you're wrong in the trade. And the the thing I always try to do is not get overcommitted to any one trade. It's very easy to get on the market and just become committed to it. It's sort of like when you find you're uh, in a public area in a crowd and you see money lying on the floor and you're just you know in the back of your mind that that opportunity isn't going to come around too often, and so you'll do anything to tear through the crowd to reach that $100 bill laying on the ground or something like that. But um, same thing happens in trades. You've entered the market, and you just sort of become committed to it. You don't want to expend the brain cells to think about a second trade after it. Um, but you'll notice that when I enter the market, I very rarely fiddle with my stop. There have been a couple times when I've done it. It's not a good habit to get into, but if you find yourself moving your stop like a lot, it's too much finessing for me. Um, uh, you need to have just a concept of how you expect the trade to play out to begin with, and then just act based on that. So if that isn't playing out right and the market is finding your stop, instead of moving your stop around, really what I'm asking myself is why is it getting to my stop in the first place? If this trade is going to go the way I thought it was going to go, why is it finding my stop? What's it doing there? All right, and so that's sort of the mindset that I get when I'm entering a trade and I think about my stop placement. And so for in this particular instance, I'm just expecting this market to go, because if it doesn't go, I mean, there's something seriously wrong with this trade. All right, especially after this bearish move here. I'm expecting it to be a sharp, expecting this to be a trap, and yeah, and I do get that push. I get taken out quickly afterward, but again, just manage to get a re-entry. I still think of the same thing here. I'm not going to move my stop below this area, because if the market is really finding selling at the point where I'm getting in long, and it comes back here, there's just no way that I'm right. At least, uh, you got to be right in your entry and also in your timing. So if the market's coming back down there, then I'm wrong on one of them, and you got to be right on both. But so that's that's generally what I adhere to. The other way to think about it is that I like my stop here because if the market were to get down there, I'd probably not be feeling bullish about the trade anymore. So you just got to think about like what does this market have to do for me to not feel bullish anymore? And the answer is, well, if it gets down there, then I'm not really feeling bullish, no matter what happens afterward, because if it pokes me out and then takes off, then so be it. It's it happens. So yeah, the other thing that I should mention is let me just take a look at this morning's trading. Okay. This morning's trades, this was rough. This was really rough. There's one thing I could say, you got to have confidence in the trades that you take. When I get into a trade, if I have any thoughts about the actual worst possible thought you can have, which is I'm not sure what's going to happen here, but let me just take this trade anyway, just to see what happens. It's like the worst thing that you can think to yourself. And I forget, there was someone that said, I forget who it was, but he said the best time to stop a mistake from happening is when you catch yourself thinking about it for the first time. I'm paraphrasing it, but it's something like that. Um, I don't know what's going to happen when I enter a trade, but I know that the feeling that I have when I enter a trade is that if this trade doesn't work out, I'll quit day trading and work at McDonald's or something like that. And that's sort of the mindset that I get when I enter a trade. Um, if I ever think, I'm getting in this trade and I'm just like, this trade may work out. Let's just see what happens here. That's a bad sign. Um, and I mean, and I guess it's sort of like to psychologically, it's like you're trying to prepare yourself for, because if it doesn't work out, you're thinking, well, okay, well, and just pat myself on the back because, I wasn't sure to begin with. Um, yeah, it's not a great thing to think. Now, I'm never thinking that, having that confidence level to the point of arrogance, because that's a whole nother problem. I, of course, every time I enter a trade, I'm very often wrong, and I don't know what's going to happen. This trade here, I didn't like where my stop was with this one, but I also, with the premise with this being, of course, there was this level here that I found buying. If the market is really going to reject off this level and form a rejection candle, I just wouldn't feel particularly bearish anymore on this trade. And so if it's going to take me out, just take me out. And um, yeah, I got I had to look at a tick chart because I actually didn't see it take me out. It was interesting. I puked the exact high. It was the high tick, and like I said, that doesn't happen too often. Um, but uh, yeah, and this trade did get it was my target. My target was at yeah, it was 25. I think it got down to 23. Um, and then I got taken out again on this trade here. I felt that it had its retrace back to this point here, and it was gonna. This is a pretty strong rejection here, um, but just wasn't ready. But that's where my stop is. My stop is, could have been a point below this candle here, but then, um, again, why is it? This move could have just continued. But the point is that my stop is in a place where, if that's going to happen, then I'm just at least at this point, I'm no longer feeling bullish. So, just get me out at, as quickly as possible. If these trades are, if this trade isn't working out the way I expected, then, I just want out. I just want to get out of that trade and just move on to the next trade. So, yeah, we did have an inside bar here, and some longs, including me, got suckered in, and just squeezed them out. But yeah, caught the third trade here. Once this, see the market actually rejected twice to the downside, and I'm thinking, all right, I think the road is clear now, because all the selling would have stepped in here. Those sell orders are not likely to be there anymore. So the path of least resistance is now to the upside. So yeah. Anyways, so that's that. Sure, there's tons more I can cover, but hopefully that's says maybe a little bit more than you can glean from my commentary list videos. But anyways, hope you guys are having a good week, and I will catch you in the next video. Take care.